Hey everybody, welcome to my channel. Hope you guys are all doing well today. In this video, we're going to go over the following topics. This is going to be a more DeFi oriented video. I've only disclosed to my Patreons which DeFi tokens I've been buying, but if you watch this video in its entirety, you'll get a good sense of which tokens I'm bullish on and which tokens I may potentially be buying. Another way to follow the DeFi conversation, if that's something you're interested in, is to join my Discord. I have an entire channel dedicated to DeFi talk. Not only that, but it's also a way for you guys to connect with like-minded individuals. You can share stories, insights, and learn from each other's experiences. Also, recently I started a subreddit. Most of the discussions that we have and the news that we publish there is DeFi or CeFi related. If that's something you might be interested in, I included a link to the subreddit in the description below. With the intro out of the way, let's go ahead and dive into this video. All right, to get things kick-started, we'll go ahead and begin this video by talking about Chainlink. There's a few events that happened this week, and I wanted to make sure you guys are up to date. I actually published a review on Chainlink. It's more nuanced than the reviews that you'll hear from other people. I don't just read articles to you, tweets, the white paper. I actually have developed a very nuanced view of the project. If you're interested in learning my insights, I included a link to a video review and a written review in the description below. Let's start off with this article. Chainlink expected to spend 25 million more on development than Ethereum. Researchers observed that 500,000 Link are sent to node operators twice a month. At current prices, this support constitutes almost $5 million a month or close to $60 million annually. At the same time, Ethereum Foundation is expected to spend $30 million this year. Meanwhile, Ether's market capitalization is roughly 15 times that of Chainlink. But also at the same time, Link's price since 2018-2019 has gone up pretty significantly. And if you look at the traditional investing model, projects usually go through a series of funding rounds. So they'll get their original investment, they'll work on a project or platform, then they'll come back to investors and they'll say, look at our project, look at what we've done, at which point maybe new investors will come in, but a new funding round will start. They'll get even more money to work on their next iteration. With an ICO, they get all the money up front. And because of that, a lot of ICO projects decided to dip. They basically took the money and they fleeced investors by not even working on a project. But here with Chainlink, they're actually working on a pretty big project. And since the team has somewhat delivered, they've partnered, they have a working product, rather than going through a traditional route, they have all those Link tokens in their reserve. So to me, the way I look at it at least is that it's the equivalent of them raising more money for additional development. Now the problem here is that you really can't hold them accountable. They could be blowing money every Sunday, every month on hookers and blow, and you wouldn't be able to stop them. So you just have to assume that they're acting in good faith. Just cross your fingers and hope they're not spending too much money on hookers and blow, that they're spending most of it on development. But to be honest with you guys, if these stinky linkies are going to take us to the promised land, I'm personally okay with them spending money on steaks and lobsters. But anyhow, coming back to this article, this aggressive spending has allowed the company to achieve key milestones such as integration with China's blockchain network and Tezos and the introduction of verifiable on-chain randomness. The co-founder of Framework Venture says that he expects the price of Link to exceed $25 in the foreseeable future. In terms of how deep their balance sheet is, Chainlink ICO raised $32 million back into September 2017. $35 million were sold in the public token sale. The remaining 65% were put aside for node operators and for the company for continued development. But based on the findings of this article, it looks like they've been spending some of the money that they reserved for node operators. Even though wallet attributions are hypothetical since most information isn't directly from Chainlink, if you just think about it intuitively, if 1 billion tokens were to be distributed, and there's only two addresses that started off with 35% of the token supply, one being the public token sale and the other being node operators, in my opinion, it's fair to assume the wallet that has 350 Link tokens still intact is probably the node operator wallet. Now this in purple is a little bit misleading because this 31 million or so Link tokens, they would have to be sold at today's price to represent $150 million. Back in 2019, they were also selling huge chunks of Link tokens. They were selling 700,000 Link tokens, totaling 9.8 million links, or an estimated $30 million. And at that time, they said that they were doing this because they needed to hire people like technical documentation writers. And you guys, this is of course after they raised $32 million through the ICO, just 2 years prior to this dumping. But this time around, they were pretty bold. Cointelegraph did reach out to them to see what they were using the money for, and they just simply declined to comment. Again, you guys, I mean, there's very little oversight over this, but for the most part, the team has been delivering. To be honest with you guys, I wouldn't be surprised if Chainlink was behind the next bull rally. Sergey, the CEO of Link, obviously has access to information because he deals with industry players directly. And he said that smart contract adoption by enterprises is about to take off. And this is not only according to the CEO of Chainlink, Sergey, but Interwork Alliance President REN SNX also shares the same sentiment. But one thing they couldn't agree on, or they couldn't prognosticate, was whether this shift would happen in 2020 or after 2020. In my humble opinion, I think most of the investment into the DeFi infrastructure and the Oracle infrastructure will probably happen in 2020. But I think with COVID going on, even though a lot of this stuff can be done remotely, I personally feel like the shift won't happen until 2021. Another factor weighing on enterprises is more regulatory clarity when it comes to blockchain technology. And I've said it before, regulatory clarity is going to be a bottleneck for the space. These more well-established companies aren't going to make big moves and heavy investments until they get a green light from regulators. Another consensus I think everybody shares is that we need to find ways to integrate both public and private blockchains into a shared and interoperable data infrastructure. And obviously one good way to do that would be with a decentralized Oracle system. But Sergey has a little bit of a diverging view. Unlike many technologists who say that blockchain is going to revolutionize everything, that everybody's going to have to adopt blockchain technology, he believes that a company just needs to have an Oracle or a connection in order to process their on-chain transactions. And by doing so, they don't have to construct their own blockchain infrastructure. They can simply leverage the benefits by connecting themselves to an Oracle. Next up, we have a pretty big collaboration with a CeFi platform, Nexo. Chainlink will provide audit trails for Nexo's lending and borrowing operations, revealing how the firm handles user collateral. In cases where interest paid on a loan is in a separate currency than what the loan was denominated in, Chainlink will provide an exchange rate for the calculating interest payments. Nexo hopes this increased security will aid the company's expansion into the prime brokerage business. The lender revealed in the same announcement it plans to build out a complete prime brokerage product suite. If you guys don't know about Nexo, I've done numerous reviews. I'll link the video in the upper right hand corner of the screen and also in the description below. And in terms of what Chainlink is going to do for blockchain players, CeFi platforms, DeFi platforms, we're just scratching the surface here. When I learned about the numerous partnerships in DeFi and I saw what DeFi was doing, I immediately started opening a position in Link because this is one of those projects that can achieve ubiquity in the entire blockchain ecosystem. Because other projects that leverage Oracle technology, they'll be able to take their platforms to a whole new level. In terms of exactly how they intend to help the DeFi ecosystem, this article here provides a few examples how to bring more capital and less risk to the automated market maker DEXs. And this article mentions 3 ways Link can help. It can help with impermanent losses. If any of you guys have used Uniswap or you've heard of Uniswap, if you provide liquidity, even though you're supposed to get a yield, in theory, you can actually lose money by providing liquidity. We won't get into this, but it's basically a commonly unknown risk that results from hyper volatility and arbitrage traders exploiting the opportunity. Also, low capital efficiency is a big problem in the DeFi space. In comparison to their centralized counterparts, decentralized exchanges need more liquidity to achieve the same level of slippage as centralized exchanges. So in other words, a lot of the capital is underutilized. And the other problem that Chainlink is going to fix is multi-token exposure. Typically, when a user provides liquidity to a decentralized exchange, they have to provide both assets in a particular trading pair. In terms of the token value, you would have to deposit a 1-to-1 ratio of Ethereum and USDC. So if Ethereum is trading at 250, you would have to put in 1 Ethereum and 250 USDC. By integrating Chainlink's Oracle system, people will no longer have to do this. They can just go ahead and supply one asset versus supplying two different assets. And to wrap things up for Chainlink, Hubei integrates services with Chainlink, will support network with standalone node. Hubei, one of the world's leading cryptocurrency exchanges, is integrating its services with Chainlink with further plans to run a full node to support the network. This is probably going to enable them to offer a whole new suite of services that they weren't able to offer their clients before. And since Chainlink is the most used Oracle in the DeFi ecosystem, it'll be interesting to see what kind of new products they come up with. And what makes this unique is that previously Binance was the first exchange to provide price data to the Oracle service. Huobi, on the other hand, takes it a step further by becoming the first major exchange to run a standalone node on the network. And you guys, this was just in the last couple weeks. Typically, the way network effects work is that this stuff just snowballs and it continues to snowball. And thankfully, a lot of my subscribers who've listened to me, a lot of my Discord members who've listened to me, we all saw the opportunity back in December. And to be honest with you, I think there's a chance that Link might produce ETH-like gains, because I have a feeling that this time around, the market's going to be driven by all the innovation that's happening in the DeFi space, and Chainlink happens to be in the center of all that. That's one thing that unites all DeFi projects. But it actually takes it a step further, because even platforms that have no intention to decentralize their financial services, or perhaps don't even offer financial services, once all the other players have integrated into Chainlink's Oracle network, it's going to become a competitive disadvantage to remain outside that network. There comes a point where Chainlink will probably achieve enough network saturation where it just becomes the industry standard. REN, Synthetix, and Curve introducing a liquidity pool to incentivize more BTC deposits. In an upcoming video, I'm going to show you guys exactly how this is done, but using one interface, you can go ahead and participate in the liquidity provision. And by doing so, you're eligible to receive this basket of tokens. So what happens is you deposit your BTC onto the address that they provide you. It gets allocated into these three synthetic Bitcoins. So in other words, let's say you put in 0.3 Bitcoin, it'll vary, but just for the example, 0.1 might go into REN BTC, another 0.1 into WRAP Bitcoin, and another one into SBTC. And by providing that liquidity, you'll get SNX tokens, REN tokens, and once they become available, you'll also get BAL tokens and CRV tokens distributed to your Ethereum address. Liquidity providers on a weekly basis will get a portion of the 10,000 Synthetix tokens and 25,000 REN tokens. This incentive will run for 10 weeks, but there is a downside to this. Since this is an experimental yield hacking exercise, the team will not be able to assess the overall yield or outcome from this pool. So if you're interested in a tutorial on how to do this, I'm going to be making a video review in the next few days. Make sure to subscribe, click the notification bell if you want to be notified when that video gets published. Before we dive into the token of the week, Parify invests $4.5 million in DeFi lending protocol Aave. Parify is a Silicon Valley DeFi VC fund. And I think this provides context as to where we are in the whole DeFi cycle. You know, in a previous video, I talked about this thread written by an investor. And in that video, I stated that a lot of what he had written in his thread had overlaps with what I was saying for the last few months. And many people at the moment are talking about how this is a bubble, that it's going to burst. Personally, I feel like this is just the beginning. Even VC funds that have invested in big DeFi projects are looking to get more exposure in the DeFi space. On July 8th, the firm announced that it invested $4.5 million in DeFi lending protocol Aave. If you didn't know what Aave was, its main offering is flash loans, but it's essentially a money market protocol. If you guys wanted to learn, just check out my DeFi playlist, and I'll include a link to that playlist in the description below. And aside from being a money market protocol, they do offer flash loans through their services, and they launched their mainnet in January 2020. Many don't know this, but previously they were known as ETHLend when they had their ICO. And this is one of the few projects out there that's poised to eclipse its previous all-time highs. At the moment, it has roughly 158.8 million locked in its smart contract. But what's starting to grab a lot of people's attention, aside from the current product suite, is under-collateralized loans that are backed by legal agreements, not just code. And this is something that I plan to follow because I think it could lead to very big things. Because most platforms out there only offer over-collateralized loans. So if they make this work, I think it would be very big for the space. What makes it interesting is that ParaFi plans to take part of the governance of the protocol once it makes the move into a DAO, or a decentralized autonomous organization. And I've said this in the past, I think DAOs are going to be the dominant model, and they're going to become synonymous with the DeFi space. And being involved early with the DAO, I'm sure it's a power grab move on their end, because the purpose of a DAO is to basically give ownership to the people that are using the protocol, and that's typically done through the governance token. And since ParaFi is moving in early, they probably want to drive the direction of the project. So in a way, it's almost like a power grab to a certain extent. But what really caught my attention here was that in aggregate, ParaFi has become one of the earliest and largest institutional investors in Lend, Aave's native token, owning $4.5 million at the time of writing. And I think this also goes against the argument that we're in a bubble. I think many of these VC firms are hesitant to get into the crypto space. They know that in 2018, 2017, a lot of funds got cleaned out. So these guys, in my opinion, are probably taking extra caution. Not only are they investing, but they're actually buying tokens. I think a lot of the price action that you're seeing in certain tokens like Rune, Lend, I've noticed for a lot of these tokens, the buying is more disciplined and organized. The charts definitely give me an accumulation feel. And if ParaFi is buying Lend tokens, I wouldn't be surprised if other VC firms are doing the same thing. In fact, I read an interview about a VC firm that seemed to be very focused on buying Link tokens and SNX tokens. So what I think is going on, many of these VC firms out there that are pretty innovative, they're getting in and they're going deep into DeFi. And they're just scooping up all these tokens. All this new information that I've come across has really forced me to shift my strategy. And I've been making massive portfolio rotation, much of which I've shared with my Patreons. Because if my underlying thesis is correct, this is just the beginning. I think many more participants are going to get involved, and they're also going to start buying DeFi tokens. Since 2018, ParaFi has invested in MakerDAO, Compound, and Kyber. And the nice thing is that when ParaFi or these VC firms invest in projects like this, they're going to do everything they can to make sure the project is a success because they don't want to lose out on their investment. So what I've started to do is figure out what tokens most of the firms are into. Because even if you buy a token today that's gone up 5x, 10x, I mean, a lot of these tokens are probably going to be either staked or they're going to be lent on platforms. I doubt very many tokens are going to be left circulating. Even though some of these big gains that we've seen may make it appear that we're in bubble territory, personally, I'm not convinced. Could we have a correction? Of course. I mean, the legacy market and the crypto market are highly correlated these days. There's a lot of unknowns out there. If the broader market takes a hit, the crypto market might go down with it. But I don't think these guys are going to stop buying. I think these guys have a big appetite for DeFi tokens, and I think they'll continue to buy. The token of the week is Statera, ticker STA. It's a deflationary token. The way it works is that this index that they've created, which contains these 5 assets, and this index programmatically enforces this ratio by selling some tokens when the price goes up and buying tokens when the price goes down. To illustrate the point, let's take Ethereum. If Ethereum goes up in price, now the ratio of Ethereum has gone up in the portfolio. And as a result, the ratio of the other tokens has gone down. By leveraging smart contract technology, some of the ETH will get sold off to buy some of the other assets that are underallocated until this allocation is returned to normal. And what makes this project really interesting, in my opinion, is the fact that every time this happens, every time the portfolio is rebalanced or there's any sort of transactions with the STA token, 1% of the amount transacted is destroyed. Another project with a similar deflationary model was the bomb token. Anytime you would send it to somebody else, 1% would be removed from the circulating supply. To be honest, I'm not sure what their end goal is or what the objective is with the project, but for experimentation, at least we found out that deflationary models like this have a profound effect on the price. So in theory, the way it's supposed to work is that every trade for the Terra creates an arbitrage opportunity. Trading attracts liquidity, which in turn attracts trading. Liquidity ripples and the supply of the Terra decreases. And the reason this came to my attention was the fact that the other deflationary model with the coin like bomb worked. And it worked as long as people were transacting that token. But the problem is that after that initial boom, people lost interest and there wasn't really a reason to buy the token off exchanges. This model here is different because it actually encourages trading, and that trading leads to tokens being burned. So it's almost like this self-feeding loop. And if it keeps going and going, in theory, you would think that the price would move with it. Now, if you're curious about my next move and you want to know whether I've decided to buy or not buy the token, you guys should definitely consider checking out my Patreon. I say this all the time, but I spend a ridiculous amount of time doing research in the DeFi space. And on Discord, I have a private channel where I'll tell people exactly what I'm doing, when I'm doing it. I'll also link them to resources that I'm reading. And so it's a really good way for them to keep up with everything that's happening on the DeFi space. So in other words, by joining my Patreon, you're basically hiring an industry analyst to do all the research for you. Not only that, but you also get access to exclusive reports that are only reserved for Patreon. If any of that intrigues you, if any of that interests you, I strongly recommend that you guys go check out my Patreon page. Well, that pretty much wraps things up. I hope you guys enjoyed the video. If you guys did, do me a huge favor by liking the video, commenting down below, and subscribing to this channel. This is CryptoOneStop signing out. I'll see you folks next time. Bye.